There's a fee inside your 401k that could cost you more than your first house. And the reason you've never noticed it is because it's written in a language your brain is wired to ignore. I know because I helped write it that way. 8 years as a bank analyst. I sat in rooms where we discussed how to present costs so they'd technically be disclosed, but psychologically invisible. The word we used was framing. The result was you seeing 0.60% and feeling nothing, while the actual dollar amount compounds against you for decades. Nearly 40% of people think they pay no 401k fees at all. That's not a failure of the system, that's the system succeeding. By the end of this video, you'll know your real number, in dollars, and what to do if it's too high. Expense ratio, 0.60%. That's the exact line people see, and your brain files it under basically free, because 0.60 sounds like a rounding error. Translate it into adult units. If you've got $100,000 in that fund, a 1% fee isn't 1%, it's about $1,000 this year. Real money. But the real damage isn't the 1,000 you lose today, it's the growth on that 1,000 you never get back, every year, for decades. Here's the career version. You're 25. You invest $500 a month for 40 years. Market returns 7%. With a 0.10% fee, you end up around $1.4 million. With a 1.00% fee, you end up around $1.0 million. Roughly $400,000 gone. You didn't write a check for $400,000. You paid it by never getting it. And it's not just a percent of your money, it's a percent of your retirement date. Mercer estimates higher fee scenarios can push retirement back about 4 years. Americans have about $10 trillion sitting in 401ks. This isn't a niche math problem. This is a nationwide leak. If this was really just small operational costs, they'd show it to you in dollars. Because that's how adults judge costs. Your electric bill isn't 0.6% of your annual income. It's $187, and you feel it. The percent sign is camouflage. 0.6% stays abstract. It doesn't trigger anything in your brain. But this will cost you $180,000 over your working life does. That creates pain. And pain creates action. So the industry does what marketers do, narrow brackets it. They take a lifetime drain and present it like a tiny annual nuisance. The CFPB has research on this. People make worse investment decisions when fees are framed as percentages instead of dollars. Same fee, worse choices. And the awareness gap proves it works. GAO 2021. 64% of people think they pay no admin or investment fees, or they don't know. AARP, cited by the CFPB, 71% don't realize they're paying fees. Nearly 40% believe they pay zero. When I was on the inside, we never called it hiding fees. We called it reducing friction. Same result. Disclosures exist. They're just built to technically comply while staying psychologically invisible. Fees don't just take money, they take time. If your account would have grown at 7% a year, then $1 lost today is about $7.61 you don't have 30 years from now. That's the part nobody feels, because it doesn't show up as a bill. It shows up as a smaller life later. And here's the funny contradiction. People will work themselves into a stress rash trying to squeeze an extra 1% of returns. Then they'll casually donate 1% every single year in fees, forever. This hits younger savers the hardest. Every fee dollar you pay at 25 has 4 decades to compound against you. The pain is invisible now, but the math is locked in now. Demos estimated fees can cost a median income 2-earner family nearly $155,000 over a lifetime, almost a third of their investment returns. The Department of Labor says a 1% difference in fees can cut your ending balance by about 28%. People obsess over how much water they're pouring in and ignore the leak in the bucket. I'm curious. Drop your 401k expense ratio in the comments if you know it. If you don't know it, say that too. I read these. It helps me see what people are actually dealing with. So you finally find the expense ratio. You think, okay, that's the fee. Not always. There's a second layer called revenue sharing. Translation, The fund company takes part of what you pay inside that expense ratio and kicks it back to the plan's record keeper. There's no line item that says kickback. You just get offered the higher cost version of the same kind of fund, and the plumbing happens behind the wall. One study out of UT Austin McCombs found revenue-sharing funds rebate about 18% of their fees to record keepers. And plans using revenue sharing don't reliably have lower admin costs. Participants just pay more. Same study. 54% of plans have at least one revenue-sharing fund, and those funds are about 60% more likely to get added to the menu. Incentives do what incentives do. And inside that expense ratio, sometimes a 12B1 fee. That's a marketing and distribution charge, up to 1% a year. You can literally be paying to market the fund with your retirement money. I found out my first 401k out of Ohio State had 3 funds with 12B1 fees. I was paying to advertise the fund to other people, with my loan repayment money. Here's the 15-minute fee audit. The mission is simple. Stop staring at percent signs and get one number you can feel, your all-in annual fee in dollars. Step 0. Benchmarks. Excellent index funds live around 0.03% to 0.10%. The average 401k equity mutual fund is about 0.26% now. Target date funds average about 0.29%. Total plan costs average around 0.52%, and small plans can hit 1% or more. If you're seeing 1% plus all in, or a menu full of R share classes and expensive active funds, that's the red flag. And if they tell you you're paying for expertise, SPIVA shows after 15 years about 92% of large cap active funds lose to the index. Where to look? Your 404A5 disclosure for each fund's total annual operating expenses. Your quarterly statement for actual admin or record-keeping deductions in dollars. And the fund fact sheet for 12B1 or distribution fees. Now the math. List what you're in, multiply each expense ratio times the dollars in that fund, add any admin charges, and that total is your number. If it's high, you don't need to quit your job. Reallocate to the lowest cost index options. Check for a brokerage window. About 40% of companies have one, only 3% of people use it. And email HR asking for benchmarking and lower cost share classes. Dana did this at her school district. One email. 2 months later, a low-cost index fund showed up. Most people just never ask. And employers respond when it's credible. 53 excessive fee settlements in 2024, $203.3 million. Punchline. The strongest move usually isn't invest more. It's stop the silent leak. It boosts every future year's return without extra risk. Remember that stat. 64% of people think they pay no 401k fees, or they don't know. That's not ignorance. That's the product working exactly as designed. This system doesn't need you to be dumb. It just needs you busy and defaulted. Auto-enrolled, auto-invested, auto-ignored. You do your job, they skim their cut, and nobody has to steal anything. It just quietly doesn't show up in your balance. When you know your number, one all-in annual fee in dollars, the whole relationship changes. Now you can compare options like an adult. You can switch to the lowest cost funds in the plan. You can use the brokerage window if you've got it. You can email HR and ask for cheaper share classes and a real benchmark. And suddenly you're not funding a business model you never agreed to underwrite. Before you contribute another dollar, find your all-in annual fee in dollars. Then decide if it's worth it. If this saved you from learning it the expensive way, hit like. Subscribe if you want one video a week. No fluff, just the stuff we were never handed.